20 pips. Danny Kirsch joins us, head of options at Piper Sandler, a man who definitely likes some action as well, searching for ranges to break and big moves to happen. Danny, welcome back. Good to see you.
Thanks for having me. Appreciate it.
Absolutely.
I agree with him. I agree with the gentleman you had before. It is a boring day.
Right. All right. Well, let's juice it up. How about we go to China for some trading? I mean, yesterday was extreme in China, and you and I have talked about that before. You've been waiting for that to wake up a little bit.
Yeah, so we talked about this last time I was here and sort of suggested, like, we don't know when it'll happen, but eventually you would expect as the Fed begins to cut, which they did last week, China will start implementing some stimulus, which they did yesterday, and perhaps there's more to come. You had a 10% rally in KWEB, like 9 or 10% in FXI, some of the China ETFs. And this was just this sort of like, I think a lot of people have gone there, and lost money trying to bet on China on the upside. And we talked about buying 2 and 3 month calls because a couple things. One, call open interest, multi-year lows, volatility, super low, nothing was priced in. And then you get this surprise stimulus, huge rally, and there's this big chase higher. And to me, what's pretty crazy, and this is something we've looked at a little bit. Yesterday you had, this is just, you can see the cumulative call volume in FXI, KWEB, and EEM. Off the charts, almost nearly 2 million calls traded between those 3 ETFs. And that speaks to what we've talked about. No one is there, and for good reason. These things have underperformed for years. Nothing has happened. Then finally you get your stimulus, everyone chasing it higher. And I still think options are very reasonable. And just to put into a little bit of context, so yesterday FXI rallied again like 9%. A 1 month straddle in FXI, so you buy a call and a put, costs about 6% a spot. So the market is pricing in less over the next month than what we moved yesterday, and that's with a 3% sell off on a lot of these ETFs today. So if you're uncomfortable chasing this and you're like saying, well, they just did it, the news is out, they're not going to do anymore. I think straddles make a ton of sense. The break evens are much lower than what we just moved. It just seems crazy to me that there really isn't much more priced in after yesterday's move. And EEM is even more stark. EEM rallied 3.5% yesterday. Implied volatility is pricing in roughly 75 bip moves the rest of the month, the next couple months, and you have an election in there. So, from our desk, what we're seeing is clients sort of step in and look at October, November straddles, calls, options on some of these emerging market ETFs, especially where they haven't had exposure and aren't really comfortable buying the stock. So we're trying to put a little bit of premium to work where we know that once this train starts moving in the right direction, it could really take off. And I looked at this today. Since January of 2023, so the last basically, vastly 18 months, Qs are up 85%, S&P is up 55%, which is insane. And KWEB is down about 8%. And FXI, I think, is up like 20%. And a lot of that was yesterday. So if you want to play for some upside, and you don't feel like you want to chase the S&P higher, which, by the way, not owning S&P, never a bad trade. It seems like it's trading at all-time highs, and again, up 50% in 18 months. Maybe that continues to work. We think volatility is still very reasonable in this space, and this is why we like owning options or days like yesterday. And this is why we talked about it last time we were here. Yeah. These calls we talked about, triple, quadruple in one day. It's like it bleeds, and then boom, you get the move.
I'm looking at it right now, August 21st, putting KWEB calls on our list. So nice trade. Like the update here. It sounds like you think there's still some more juice to squeeze. How come the options market is so unreactive there? What's going on? How come
I think it's treating it like volatility got a little more expensive, but I think it's treating it like this is a one-time move. There's not a lot more to come.
Boy,
and that
chart doesn't look like that.
Hasn't been the case. And if we expect the Fed to continue cutting, China's telling you their playbook, right? We're going to cut too. As long as the U.S. cuts, we'll cut. And the U.S., we're pricing in another cut and a half for the November meeting, and then another cut and a half for the December meeting. So you've got roughly 3 more cuts priced in for year end. I would say it's like view U.S. cutting as China stimulus. And if that's going to be the playbook, I would be owning these kind of options around Fed meetings.
Okay. The KWEB chart, too, also looks like it has distinct catch-up potential because the move in FXI looks like it's for real. Like, it looks like very different than other failed rallies of the past. It's the first meaningful higher high we've had in the chart in 3 years. We already put in basically a double bottom at $20. Now, this is the KWEB chart. That's what I'm saying, is that there's still a big $3 difference between where it's at now and its high. So, but the point is that it kind of looks like to me like the whole China trade like this is a little bit different this time.
Absolutely. It's a giant move. And again, the volume you saw on the call side, I think speaks to
that was an incredible
interest
chart.
in getting long. And then that's how you start these positions, right? You buy calls to start, and then you start looking at the individual stocks. You start doing the work. This is, I think Stan Druckenmiller talked about this. You buy a little to get the position on, and then you go from there and you start doing your work. And I think that's what happened yesterday. And next thing we know is you get the big inflows.
Okay. All right. So you're sticking with upside and the vol cheap enough to buy some upside. Danny, how about for stocks? Seems like generally betting on like a big outsized move is one of the trades you're looking at. I was kind of surprised looking at it because it kind of looks like a low probability trade, but the risk reward, the payout for a big move in U.S. stocks is worth it.
Yeah, so one thing we've been sort of keeping an eye on, at least into the next month, 6 weeks into the election, was one area. So we see a 2.5% implied move right now for the U.S. election, and fairly low. We'll see as the election approaches. I'd imagine that implied move will expand. As far as a sector we like on the long side there, that would be financials. We've talked a lot about financials in the past. We looked at regional bank downside, regional bank upside. I think XLF is sort of the trade here. In November of 2016, when you had the GOP sweep, XLF rallied 14%. November of 2020,
right,
we were falling. We were getting out of COVID. I understand that there was a different circumstance. XLF rallied 17%, and then another 6% the month after. In the month of November, the last 10 years, XLF has just averaged a 6% rally. Implied volatility, not pricing in much for the election for whatever reason why. I like owning XLF 3-month calls. I think they're incredibly cheap. If you do get that GOP sweep, probably get the yield curve to steepen. And I'd imagine just the regulatory risks that financials typically incur go away under a GOP scenario, or they're less, I'd say, negative than if there was like a Democratic sweep. And in a mixed Congress, I still think that's probably bullish XLF. And again, this is an area where options are not pricing in very, very much. So we've been buying November, December XLF calls, shares outstanding in XLF, multi-year lows. I think they've basically hit their highs in 2021, 2022. There just isn't a ton of exposure there. I think it's because it's been sleepy. It's not an AI trade. It's not a tech trade. It's not a China trade. It's kind of boring. But that's sort of the situation we like, is that gets options cheap. And when there's not a lot priced in, this is how you get very cheap right tail convexity with a catalyst, which we're going to get. And we also will have earnings as well before that, but the big catalyst is going to be the U.S. election.
That's a fun trade there, specifically to do it through banks. Good reference, too, on historically what happened to that group. I like that way to get into it as opposed to maybe just direct through the index and stocks. And nice trade on China again. Appreciate the fresh look at that. Thanks, Danny.